It is my pleasure to be here. My question relates to the Berkshire insurance operations. When I look at the quarterly balance sheets of the last 2 decades, I noticed a pattern that I kindly ask you to discuss. The sum of cash plus fixed income always hovers around 100% of the amount of insurance float. Therefore, my question is it fair to say that from the 128 billion of consolidated cash plus fixed income as of March, 116 billion actually needed to support the insurance operations?
No, I appreciate it.
The answer is no, yes.
Yeah, the answer is no. But he deserves an explanation of how this, maybe I haven't looked at it the way he's looked at it. But we have we would much rather have a number closer to 20 than to have 116. And we do not correlate or in effect measure the float and then decide how much to put it or leave in cash and fixed income. It's the fact our float keeps growing, and lately our cash, which is by design and has been terrific for us, and our cash and cash equivalents has grown because the competition for acquisitions has become much stronger as money is piled up in with the buyers of businesses and because debt has been so cheap and a variety of factors. But I don't think those are necessarily permanent. In fact, I'd be reasonably sure they aren't permanent. It's just a question of when they change. We are not tying, as Charlie said, we're not tying the cash and cash equivalents at all. The float has surprised me. The float went up $2 billion in the first quarter, and there is no way that float can shrink a lot in a short period. It structurally has been set up in such a way that it cannot shrink. And actually, I think it'll grow a little bit for a while. I've always been amazed by how much it has grown. We've got so much more float than any property casualty company in the world, and it's pretty amazing that it all came from that little building that Jack Ring built and picked the location because it was near the tennis courts. Okay, Carol? Charlie.
There are encouraging recent developments. Some of the cash has gone out recently for securities we vastly prefer over the cash. And we have a lot of cash that could be remaining that could be deployed in securities we might like a lot better than Treasury notes. So stay tuned.
Yeah, to make it very simple, in the first quarter we earned from operations, we earned a little over $5 billion. Now, we only spent about our depreciation. Normally, we would spend somewhat more than that, but that's 5 and a fraction billion. $2 billion came in net from float, so that's $7 billion that basically in the first quarter that would have been added to our cash if we hadn't done something with it. And instead, our cash and equivalents went down because we net invested more in equities by some margin than the 7 that came in. But we do have this position where even absent a change in float, about 400 million comes into Berkshire every week, which is very comfortable. And we want to get it so that more than 400 million is going out into productive assets, and we succeeded in doing that in the first quarter. Net, we improved our position in the first quarter.